Well, the year isn't quite over yet, but right now, if you're tracking things, we are having the best year for mergers and acquisitions since 2015. Global M&A volume this year surpassed $4 trillion. That's the third time that it has ever passed that mark. But recently, my next guest says, it's been sensing a bit of change in tone. Gregg Lemkau is the co-head of investment banking at Goldman Sachs, but also, of course, helped run M&A for a long time. A lot of different things under your purview. Thanks for joining us here.
Thanks for having me.
Let's talk about that bit of a change. Again, very strong year 2018. Yep. Market volatility does tend to sort of affect confidence. What are you hearing in boardrooms right now in terms of the willingness to make the big decision when it comes to M&A?
Well, it's interesting. As you said, for all of 2018, we had the third best year on record, so $4 trillion of activity, and really hallmarked by large transactions. You had 45 deals over $10 billion, which was a meaningful increase from last year. And we started the year with big consolidating transactions and with tailwinds from tax reform and strong earnings growth and strong optimism and CEO confidence. And for the first 3 quarters of the year, we probably had a top decile environment for M&A, and we were on pace for a record. And then we hit the fourth quarter and things slowed down a little bit. And it's interesting, when I'm out talking to CEOs and to boards, they're still quite confident in their own business. They're confident in the tailwinds they've got and the earnings growth, and employment is still tight. But I think they're actually a little bit reactive to the markets and some of the political and geopolitical concerns out there. And there's just been a little bit more of a circumspect attitude towards M&A over the past month or two.
Is it more just from looking at the equity markets every day, or are they seeing things in their business, for example, wondering what the impact is going to be ultimately from the trade war with China or things like that that are making them say, let's wait?
It's interesting. It feels like a bit of a combination, but more reactive to news events and potential news events than it really is to underlying performance in the business. So there's been anxiety about China-U.S. trade, there's anxiety about interest rates, and there's been lots of market volatility. I think that's caused people to just take a little bit of a step back, really over the last 4 to 6 weeks, and we've seen a little slowdown in activity, not fully pens down, but just backing away. And really looking to gear up as we head into 2019.
Right. So what you've been through, and I've been through many of these kinds of cycles where it changes a bit. What changes that? Is it simply that we get a quiescent equity market and suddenly everybody's okay?
Yeah, I think there's a possibility that a return a few more days like today in the equity market, or a few more hours like today in the equity market, could get confidence back. It also may just be people coming back from the break and looking into 2019 and figuring out what are the strategic things they want to try to achieve over the course of the year.
Tax reform will have been anniversaried. Does that play a role at all in the willingness to use capital?
Yeah, it clearly was a tailwind that we saw this year for people, but I think it's continuing to drive growth in business, and I think that's part of what drove $4 trillion of activity this year. Now, it also drove $1 trillion of share buybacks, and so that capital will get put to work. It'll get put to work to growth if it's available, and if not, it's going to get put to work buying back stock, especially as the stock market dips down a bit.
The M&A market for the last few years has been dominated by strategics, but PE firms have poked up their head. I mean, there's a few things I've been tracking, whether it's Arconic or Nielsen, or there's a number of different large LBOs that have at least been discussed lately. Sure. Are the credit markets an issue there? Are the PE guys kind of acting late cycle here and going to really be as active as it seems?
Yeah, it's fascinating. I would say for all the headlines, which have been big transactions driving the market, the actual pickup in activity broadly underlying the strength of the M&A market has been private equity. You've probably had 30% of transactions have had private equity involvement in one way or another, and that's really without any major take-private transaction over the course of the year. You talked about a couple that might be rumored, but there's been no real big take-private deals over the course of the year, but activity is steady. You've got a handful of funds that are in the high teens in terms of billions of dollars, or north of $20 billion. I think there's $700 billion of dry powder in private equity, and so that will continue. What's been interesting this part of the cycle, as opposed to the past, is they've continued to invest through ups and downs in the cycle. I think private equity is putting capital to work. The returns to the cycle have shown that it makes sense to continue to put capital to work, and I think that will continue into 2019 and potentially even pick up if the market correction holds.
And what about the credit markets themselves? Can they finance large deals and or strategic or otherwise at this point? Because there does seem to be, at least we bring people on, everybody wants to be concerned about the credit markets, but I haven't been able to tell that there really should be a lot of concern.
It's interesting. The high yield markets have gotten a bit softer in the past couple of weeks. What's taken the place has been the leveraged loan market. The leveraged loan market has picked up dramatically, and so you've seen a handful of transactions really get funded largely out of the leveraged loan market. I think if that stabilizes and the high yield market stabilizes, we'll be able to see big transactions continue to get done in 2019, but I'm not sure you'll see much between now and the end of the year, given some of the volatility in the high yield market.
All right, so we'll keep an eye on high yield. All right, so give me a sector next year that perhaps we should be focused on when it comes to consolidation.
Now, if you look at what we had, the TMT was quite active this year, technology in particular. You actually had natural resources broadly reasonably active. You had healthcare, which has driven M&A activity historically relatively slow. So you had a reconfiguration of the healthcare services market with CVS, Aetna, and with Express Scripts, Cigna. But you haven't seen a big wave of pharma biotech or biotech like we have in the past. And actually, I think that's a sector where we could see continued activity through 2019.
You think so? So, I mean, think of an Amgen or a Gilead. These are companies with a lot of balance sheet capacity. Things are changing so quickly. Gilead, for example, has suffered. I mean, are these the kinds of acquirers that conceivably we should imagine?
Yeah, I think what's fascinating across biotech generally is there's an amazing amount of science and growth, and you saw biotech equity issuance at a record level this year. So you've seen creation of new companies. You saw Moderna go public last week. So there's a new wave of unicorns in the IPO market that are really coming to biotech. As you've seen big pharma historically need to buy biotech to drive growth, you now see kind of mature biotech that's having the same kind of thing. Their growth is tapering. They're big market cap companies, and they're going to look to do M&A to continue to drive their pipeline.
People may not know, you're an old healthcare banker from a long time back. Spent a lot of time in Europe as well. Are we ever going to see the likes of the consolidation, though, that we saw in the aughts or even in the 90s?
I think there's probably one or two big deals left that could happen. I'm not sure they will happen. What was interesting, probably the only headwind we've seen around M&A with all the big transactions has been regulatory. And it's actually uncertainty around regulatory. And the big challenge has been this wave of nationalism and protectionism. And I think if you look at some of the big pharma companies that could consolidate, lots of them have characteristics of nationalistic champions that I'm not sure you'll see the consolidation that we saw in the aughts and in the 90s.
Yeah. All right. We've talked a lot about pulling money out of the market, a la M&A. What about putting it in as in IPOs? It's funny, you're not an M&A guy anymore, overall investment banking. We see a lot of Chinese companies that have gone public here, for example, during the course of 2018. Next year, we finally going to get some of our big U.S. companies that we know so well onto these markets?
I think we've turned the corner on that. So 2018 was a great year for equity issuance. We saw a massive increase. I think these unicorns that we've been talking about for some time that have stayed private longer have started to come public. You saw Spotify do a direct listing here. You saw Dropbox go public. You saw Farfetch, another European company, go public. We saw 7 companies in China, 7 technology companies greater than 10 billion of market cap go public, and more than half of them actually in the U.S. So what's fascinating, given all the discussion around China trade wars, have been China companies accessing U.S. capital from U.S. investors to drive growth of these big Chinese technology and internet companies.
Don't say it too loud, somebody from the administration could be listening.
They could be. But there's a big wave. There's a big wave of these U.S.-based technology unicorns, biotech unicorns, and now I'd say also the Chinese companies. There's a continued pipeline behind that too. So I think 2019, notwithstanding the equity market volatility, will be a big year for IPOs.
It occurs to me there's another company coming public here soon named Dell. You were kind of involved with that a bit,
It's fascinating.
weren't you?
It is, for all of the returns to the public market, the probably great untold story is the return to the public markets of Dell. I think that transaction is scheduled to close at the end of December. And it's fascinating if you look at the transformation that Michael Dell and Silver Lake did with that company in its private incarnation. They did kind of exactly what you're supposed to do. They sold off Perot Systems. They sold off a slow growth software business. They bought EMC. They bought VMware. And they've really reconfigured the market share and the growth of that business to be positioned to be probably one of the most exciting new public companies, again, in 2019.
Gregg, finally, I'd be remiss if I didn't ask you as a senior executive at Goldman, whether you're seeing any impact. I know you can't really comment broadly on the 1MDB situation itself, but are you seeing an impact in terms of your business at this point, or a pullback perhaps from some clients as a result of the coverage and of what's going on?
Yeah, so I'd say the whole Malaysia situation is distressing, right? You had actions by individuals that were inconsistent with the culture of the firm that I've worked at for 26 years, which is focused on excellence and integrity and serving clients. We have a small handful of people that are focused on dealing with regulators and authorities, and the rest of us are just out with our clients. And out with our clients talking about their businesses, not about our business. And what's been quite encouraging has been the resilience of that client franchise. So there's been clients standing by us and really wanted to engage with our teams on their issues. And we've continued to win some very high-profile mandates for high-profile companies going public. We've continued to win mandates for governments across the world doing business with us. And so we feel quite strong about the resilience of the franchise. But we recognize that there's continued to be issues hanging out until this Malaysia situation is resolved.
And as we head into comp season as well, I can't help but notice your stock price is down almost 35% over the last 12 months.
I've noticed that too.
Does that hurt morale at all?
Yeah, I don't think people follow the stock day to day. I think they're kind of focused externally on their clients. And if you want to look at it as a glass half full, we'll just get more shares in terms of compensation at the end of the year.
That's a good way to think about it. Greg, thanks for joining us. Appreciate it.
Thanks, David.